Energies beat expectations for fourth quarter earnings on Wednesday. Higher trading profits in the gas market helped the French energy giant offset some of the impact of low oil prices and weak fuel demand. Adjusted net income for the final 3 months of last year was $4.4 billion. That was down 15% from $5.2 billion a year before, but slightly higher than the third quarter's number and beat expectations. The company said it expects higher gas prices, upstream production and power sales early this year. Investors cheered the news and Total's share price rose around 1% in early trade. The update comes while Western oil majors face reduced economic activity and competition from new African and Asian refineries. Last week, rivals Shell, Chevron and ExxonMobil all reported fourth quarter earnings hit by the downturn in refining margins. Total was able to end the year on a higher note thanks to its integrated LNG division. Traders captured higher profits due to market volatility and boosted earnings by 35% to $1.4 billion. Novo Nordisk forecast growth to slow down this year, but investors were happy to hear Wegovy sales more than doubled in the final quarter of last year. Analysts described the results as good enough to ease nerves about competition from rival Eli Lilly. Shares rose over 4% as fourth quarter earnings came in above forecasts Wednesday. Investors were worried ahead of the results about potentially slowing demand for obesity drugs in the US. The company also faces tough competition from US rival Eli Lilly. Novo lost out to Lilly in the fourth quarter in terms of total weekly prescriptions written for Wegovy compared to Lilly's Zepbound in the US. Novo Nordisk said fourth quarter operating profit jumped 37% to $5.12 billion, better than analyst forecasts. Sales of Wegovy more than doubled to $2.77 billion during the quarter from a year before. The number was in line with expectations and higher than the third quarter. The firm said it expects sales growth in local currencies to range between 16 and 24% this year. That's lower than the 26% growth seen in 2024.
Google parent Alphabet shares slid in after-hours trade Tuesday after its cloud unit posted weak sales, and despite the company announcing a plan to spend big on AI. The tech giant said it would spend $75 billion on its AI build-out this year, 29% more than Wall Street expected. However, investors began signaling impatience over profitability. Shares of the Google parent fell 9% in extended trading. That roughly offsets the company's gains on the year so far. One analyst told Reuters that up until now, Google Cloud has grown fast enough to tamp down worry over ramped-up spending. Alphabet CEO Sundar Pichai defended the dramatic increase on a conference call with analysts. Some are raising questions about AI capital spend by Google and U.S. rivals after the emergence of China's seemingly low-cost DeepSeek. Pichai said Google's Gemini family of AI models is comparable in efficiency to DeepSeek, and that, quote, the cost of actually using AI is going to keep coming down. Alphabet has been spending heavily on infrastructure development to support AI research and integration into products such as search and cloud services. The company's CFO said the majority of CapEx for 2025 would go into building servers and data centers. Alphabet plans to spend as much as $18 billion in the first quarter. That's a far bigger number than the roughly $6 million DeepSeek says it spent on the final training run to develop its AI model. Developers at leading U.S. AI firms say DeepSeek's total training spend was likely much higher. However, the news about what it says it spent shocked tech stocks in January, contributing to NVIDIA's record one-day drop of $593 billion in market value.
Japan's Toyota raised its full-year operating profit forecast by 9% on Wednesday in a sign of confidence in its ability to ride out the impact of any potential US tariffs. The world's top-selling automaker raised its profit forecast for the current year through to March to $30.7 billion. That's despite posting weaker than expected earnings for the third quarter. Operating profit for the 3 months through to December was down 28% from a year earlier. In recent quarters, Toyota's profit was pushed higher by strong hybrid vehicle demand in the US and other major markets. Operating income in North America, though, fell 63% over the first 9 months of the financial year. That was mainly due to a decrease in sales volume and higher personnel-related costs. Income in China also declined during that period, where it's been pressured by higher marketing costs amid heavy competition from Chinese brands. Toyota said it would establish a wholly owned company in Shanghai. It will develop and produce electric vehicles and batteries for its luxury Lexus brand, with production set to start in 2027. Last week, Toyota reported global group unit sales of 10.8 million vehicles for 2024. That made it the world's best-selling automaker for a fifth successive year. Its share price was up 4.7% towards the end of the Japanese trading day.